Welcome back to Investing Talk Podcast.
Today we're looking at New Era Energy and Digital.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. The first thing we really have to discuss is just the audacity of their strategic transition.
It's a huge pivot.
It is. I mean, they didn't just add a digital division. They completely rebranded, right?
Yeah.
They threw out their old name, New Era Helium, to show they're all in on becoming a major player in this next generation of data infrastructure.
And the scale they're talking about is, frankly, staggering. So it's not some small expansion.
Not at all.
They are aiming for an absolutely massive footprint in AI-powered data centers. When you look at the targets, we're talking about up to 7 gigawatts of potential capacity.
Just in their proposed New Mexico campus.
Right, just in New Mexico. And then there's another 1 gigawatt planned for Texas through a joint venture.
And to put 7 gigawatts into perspective for you, that's not just big. That's approaching the size of a utility company's entire generating capacity.
Wow.
A single one of these big hyperscale data centers usually runs somewhere in the 50 to 100 megawatt range. They're planning for 7,000 megawatts.
So they're essentially betting the farm on this one idea.
Exactly. They're betting the entire future of the company on building the infrastructure backbone that this whole AI revolution needs.
Okay, but here's the big question. How does a company like this, a company in transition, compete with the established giants? I mean, you've got Amazon, Microsoft, all these specialized REITs that have been in this game for decades.
Well, their claim is that their competitive edge isn't about size today, but about innovation for tomorrow. They're highlighting 2 specific areas. First is proprietary AI resource management systems. So, software designed to optimize power, make things more efficient. And second, they're talking about advanced engineering for their campus facilities. They believe it puts them way ahead of legacy operators who are still using older models.
So their whole pitch is that they're building the Ferrari of data centers while everyone else is still driving last year's sedan.
That's a perfect way to put it, yeah. They're trying to skip generations of technology, hoping to jump straight to the kind of efficiency you need for these really high-density AI workloads.
Which need a ton more power and cooling.
A ton more. And if their tech actually lives up to these claims, that efficiency could be the competitive moat they so desperately need.
Okay, so that's the vision. It's ambitious, it's aggressive, you can see why it's exciting the market. But for us, we have to pivot to the financials.
Of course.
Because the second you start talking about building 7 gigawatts of anything, you have to talk about capital. And that's where the story gets really nuanced.
It really does. The vision runs right into the cold, hard reality of the balance sheet.
Right.
And this tension between their aggressive growth and their persistent losses, that's the core conflict for any investor here. So let's look at the numbers for the 9 months ending September 30, 2025.
Well, let's start with the good news. Where's the growth? Where's the traction?
Okay, so revenue growth is substantial. It reflects that they're getting these digital operations off the ground. They reported total revenue of almost $695,000 for that 9-month period.
And Q3 was strong.
Q3 was particularly strong, yeah. Over $532,000. So the top line is definitely moving up, which, it validates the initial pivot.
Okay, but that growth has to be coming at a crazy cost. What about the losses?
The cost is steep. For that same 9-month period, the loss from operations was over $8.1 million.
Wow.
And the net loss for just Q3 was over $3.6 million. That works out to a diluted EPS of negative 21 cents.
That is a staggering disconnect. I mean, they're bringing in a few $100,000 in revenue, but they're bleeding millions every single quarter to build this thing out.
It's classic growth at any cost.
It is, but it raises some really serious questions about when they might actually become profitable.
It does. Right now, profit margins are just deeply negative. And that's not, totally shocking for a huge infrastructure build-out, but it puts immense strain on their financials.
And you can see that pressure when you look at the valuation.
Absolutely. The market cap is around $114 million, which is respectable, but the price-to-book value is... it's deeply negative.
Let's pause on that. A negative price to book. For anyone listening, what does that signal, especially in a capital-heavy business like this?
It signals negative shareholder equity. Basically, their liabilities are higher than their assets. It's a sign that this build-out is being funded by taking on more obligations than their current asset base can cover.
So the market isn't valuing what's on the books today.
Not at all. It's valuing the future potential of that AI vision, not the current substance of the balance sheet. It also means that structurally, they're going to need a lot of capital just to fix that equity hole, probably through more financing or dilution.
Which leads us right to the most worrying thing they filed recently, that going concern warning. That phrase, even in high-risk stocks, it just makes you sit up straight.
It absolutely should. Their free cash flow is negative, which means they're constantly exposed to the capital markets. And in September of 2025, management itself expressed substantial doubt about the company's ability to continue as a going concern.
So that's management basically raising the alarm themselves.
Exactly. It's a formal statement saying, look, our losses and our reliance on outside cash mean our survival isn't a guarantee. Their cash position did improve a bit to about $14.2 million, but that warning just highlights the huge gamble they're taking.
So they have to scale up and find more money, or this whole thing just grinds to a halt?
That's the race they're in.
Okay, so they need capital and they need it now. How have they been handling financing recently? Because that tells us a lot about the cost of this ambition.
They've been incredibly active. In October, they made a good move. They paid off the rest of their senior secured convertible notes, which helped clean up the capital structure a little.
Okay.
And at the same time, they proved the market is still buying the story by raising $13.8 million through an equity purchase facility.
So there is some investor confidence there. But then almost right away, they had to go get another loan in November.
Right.
That tells me the cash they raised in October just wasn't enough.
You're hitting on the critical point. They entered into a $4 million secured promissory note. And the thing that really stands out about this new financing is the price tag. It carries an 18% annual interest rate.
18%.
18.
That is not standard corporate financing. That feels like almost emergency funding. What does an 18% note tell us about their immediate liquidity needs?
It tells us two things. First, the capital markets are pricing the execution risk here as extremely high. Lenders want a huge premium because of that going concern warning.
And the second thing?
The second is that they had an immediate pressing need for cash. They needed that $4 million right now to keep the lights on and keep construction moving no matter the cost. They are prioritizing speed over everything, even if it means taking on really high-yield debt.
Okay, so we've got a massive vision backed by today's extremely expensive debt.
Yeah.
Let's shift to market excitement, because despite all these financial headwinds, the stock has actually shown some pretty significant momentum.
It has. This stock is, inherently volatile. The beta is 1.20, so it tends to move more than the market. But the short-term trend has been undeniably bullish.
We saw that big surge, right?
We did. A huge surge of over 12% in a single day on October 30th, driven by some positive tech announcements.
And the trading volume is consistently high, too, often over 3 million shares a day. That tells me this isn't some quiet institutional play. This is on the radar of retail traders, tech funds, people betting on the AI theme.
And that volume is being fueled by tangible progress. It's not just rumor. They are hitting real milestones that help validate this whole pivot.
Like what?
Well, for example, they completed phase 1 engineering for their flagship AI data center campus. The blueprint is done. Construction can speed up.
And power is the whole game here. What about the Texas site?
They launched strategic power agreements for the 250-megawatt campus in Texas. That is crucial. You can build the world's most advanced data center, but if you don't have guaranteed, cheap power, it's worthless. Securing those deals is a huge step.
And the New Mexico land grab for that 7-gigawatt dream, have they locked that in?
They've secured a 2-year option on 3,500 acres there. So that option gives them the long-term flexibility and scale for that enormous campus they're envisioning.
We also can't ignore that they restored their Nasdaq compliance in October. They avoided a delisting hearing.
Yeah, that was a major risk taken off the table. In the face of all this financial scrutiny, showing you're compliant is key for confidence.
Right.
Now, while all that tangible progress is happening, you also have the noise. Market sentiment is highly speculative, and it's being fueled partly by unconfirmed rumors.
The classic whispers. Strategic partnerships with huge AI firms, maybe some M&A interest.
Yeah.
The usual stuff that gets traders excited.
Exactly. And we have to stress these are unconfirmed, but they're definitely contributing to the high trading volumes and the wild intraday swings. People are trading on a narrative of what could be.
So we've got a company racing against time, burning cash like crazy, but also delivering on milestones.
Yeah.
If you're tracking this company, what are the immediate flashpoints? What are the big catalysts in the next 3 months that will either validate this risk or, deepen the concern?
The immediate flashpoint is financial. It's tied directly to that expensive debt. The maturity of that $4 million promissory note is scheduled for December 6, 2025.
So that's the moment of truth for their near-term liquidity. How they handle that repayment or refinancing is going to be the clearest signal of their cash situation going into the new year.
It's going to be intensely scrutinized. And right after that, we roll into earnings season. The Q4 2025 preliminary report is expected in January.
And that's not just about revenue anymore, is it?
No, now it's about seeing some proof of better operational efficiency. Critically, everyone will be looking for a narrowing of those huge operating losses and that negative cash flow.
And on the index side, there's always the mechanical movement. ETF rebalancing at the end of January could influence volatility.
For sure. And for anyone looking for institutional validation, the Q1 holdings disclosures due in March, that's when we'll see if the big funds are actually dealing positions here.
And the speculative stuff is still bubbling away.
Always. The market is buzzing about a potential partnership with a regional AI hardware provider for that huge New Mexico campus. A validated partner for a project that big would, well, it would significantly de-risk the entire thesis.
Okay, before we wrap up, let's just step back and hammer home the structural risks. We've painted this picture of incredible ambition, but we can't ignore the problems that led to that going concern warning in the first place.
The risks are clear, and management has acknowledged them. The operational losses and negative cash flow are the primary hurdle. They're in a race against the clock on their liquid capital.
And that high beta means this stock is vulnerable to broad market swings. It can magnify any losses.
Precisely. This is not a safe, low-volatility infrastructure play. It's an early-stage, speculative tech gamble. And if capital markets tighten up, their reliance on this expensive debt could lead to significant shareholder dilution.
So you have this incredible friction, a strategic vision to dominate the future of AI data, clashing right up against huge execution risk and these persistent negative financials.
The central investment question for the next few quarters is all about timing. The market agrees that AI data center space is booming. The only real question is when new era scaling will finally hit critical mass, the point where positive cash flow starts to appear, fundamentally solving that going concern problem and justifying that 18% debt they took on. That journey from burning cash to actually making it is what determines the value here. The only thing that's certain is that those next three catalysts, the debt maturity, Q4 earnings, and institutional flows, they're going to be defining moments.